Hello, everybody. My name is Radovan Vojtko, and I'm CEO and Head of Research at Quantpedia. And I'm very happy because I have on a call Jerome Kreuser and Robert Shumaker. If you remember, we had a great discussion in Quant Beats episode number 3, where we discussed market bubbles. And I'm happy that I have those guys back in my video, because we will have once again discussion about the bubbles. So thank you guys. Thank you for joining me. I would like to give you opportunity, Jerome. You have a nice presentation for us. Please show us your screen, show what you have for us, and we will go through that, and then we will have a few questions and some discussion.
Okay, sounds good. Thanks for having me, Rado. And here's the beginning of the presentation. So I think I'm going to jump right into things. And also we have Robert Shumaker on the program here, who is really our practical implementation manager and portfolio manager for actual use of any of these tools. What I want to do today is explain what is called the Efficient Crashes Optimizer. That's abbreviated to ECHO, obviously. And it's about bubbles, but it's not all about bubbles. And if you look, the problem of bubbles, it's been solved by others, many people throughout history. We won't go into that. I want to mention a few in an upcoming slide. The difference between ECHO and what some of the other things do is that it tackles bubbles and also anytime, anywhere. What is that? Well, I'm going to explain that down the line, but basically it means it's not only for bubbles, which is different than some of the other technologies. Okay, so I want to just outline the things that we're going to talk about, because we had talked about some bubbles in a previous presentation, but now we're going to go into it a little bit deeper in explanation of essentially what is going on in the background and how it works.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
What I want to talk about is really where we are in the state of the art in bubble methods, including ECHO, which, of course, I am biased, but I see it as a slightly better way to tackle things under certain circumstances. It really depends upon what you want to do in the background. The thing about ECHO is it applies the Kelly criterion everywhere and anytime. That's what I mean, and it's not just for bubbles. If you're familiar with the Kelly criterion, what it does, it attempts to estimate whether the probability increasing or decreasing is bigger, or the probability of being more likely winning than losing is bigger. And then it allocates a bet size based upon that criteria. Well, there's a lot in that statement. We'll take a look at it down the line. The ECHO components consist of an estimation part and jumps relative to a normal price. In other words, really what we're assuming here is that the actual price is oscillating about a normal price. You'll see how that looks in a minute. We also include the super exponential acceleration, which means that if you have asset, and everybody wants to think about, okay, are we in a huge bubble now? I'm not going to answer that directly now, but maybe in the next presentation we will. And what that means is when things are exploding, interest returns are actually increasing. They can't increase forever, obviously. And when you get a super exponential increase, it's bound to fail soon. We're estimating crash probability and crash size, all relative to the normal price. This is the critical point here. Kelly calculations and the importance of bet size. This is very important. The bet size does really basically most everything, and it gives you an idea of how to bet more, how to bet less, or to go in the case of a stock or an asset, how to go long or short. The model that contains all this information has to have a lot of parameters estimated. The way we do that is via machine learning. Essentially, that just means going back in time and looking at similar situations and estimating the parameters when things look good. Well, precisely what that means. And then we'll talk about a few applications. And final application is our AugerMax portfolio, which is a global tactical asset allocation portfolio with ECHO, which estimates using 30 assets, a portfolio to generate extra alpha and prevent possible crashes and at least big downturns. What about the firms now devoted to analyzing bubbles? Well, I mentioned three here. One is a black swan, the essence, which is nice, but the problem is it looks for huge crashes where the signal is essentially not in the price. This is fine. Taleb has made, as far as I know, some decent returns on his model based on this concept. However, the problem here is that you may have to wait a long time for a big crash to occur. How long can you wait? I don't know. That depends upon the people that you're working with. Dragon King is a very beautiful implementation, a model and actual implementation, because now he has his own website of bubbles. And these are basically bubbles which move into a position where they retain an unsustainable feedback, like you have here. It's accelerating so fast, can't keep this up. So at some point it's going to crash down. And they have very elegant ways of estimating that. And you can see here for another example of how the price is accelerating and finally crashing. The idea is to estimate not, precisely. One is never going to get it precisely, but you want to estimate it probabilistically so you can end up winning more times than losing. That's the whole point of it. Don't ever think that somebody's going to give you a product that's going to work all the time, because they're not. Too many factors in term here. Well, is AI going to sort it out? Not likely, because of all the emotional factors. But in this case here, the signal is included endogenously in the price. And what's the difference with Echo? Well, it's the same thing. Unsustainable feedback, it includes that. I'll show you how that works. Correction size, about a normal price. This pink line here is the normal price. These are assets which are, this is a short term, so you don't see it. You'll see it in subsequent graph. To obtain a probabilistic prediction anytime, anywhere. The important difference here is that it works anytime, anywhere, but it's not as efficient, certainly, as Dragon King is on longer term estimations of bubbles. At this point right now, it's really more on a short term basis. Long term is in the works, but generally you need to think of it in terms of, estimation in the next couple of weeks. And it includes the bet sizing, which means bet more when the probability of winning is greater than losing. And that's the essence of the Kelly criterion. What are the assumptions? Assumptions on our model are that the bubble model is the prices are geometric random walk with separate crash and rally distributions. Now, these are log scale, so this looks pretty much linear with the asset oscillating about it. Well, not totally, but sort of. It'll come back up here. The price oscillates around what is called the normal price here. The asset price accelerates as an increasing function of crash amplitude in some places, generating an exponential price dynamic, as you see here. It's accelerating up, not so much, but pretty much. And these are log prices, remember, log of the prices, and finally breaking down here. And you have the normal price here, which is estimated along in a linear fashion. This is actually log of the normal price of the Hong Kong index and the Hong Kong log price, which is the blue line here, from the 10-year period from 79 to 99. And this is the asset price in log. So this is generally what we expect it and presume that it's going to look like in the long term. Well, this is the crash amplitude. It's not, obviously, this is a big crash, but it's always relative to the normal price. So it consists of a number between 0 and generally something like 1.25. It never generally gets much bigger than that. But it's a price which is a relative number between the actual asset price and the normal price. And that is a number between 0 and 1.2 generally. Also for recovery, you don't see too much in the way of big jumps in recovery here, maybe a little bit down here. Generally you see much more major crashes and less in terms of rallies, but the method handles crashes and it also handles rallies, or it's designed to do that. What is the bubble model? It's called the rational expectations model. The RE condition, the rational expectation condition, has two components. It's expected return, a probabilistic combination of prices continuing as is, or in the correction and recovery. So it looks something like this. It's not that messy, really. This is the expected return of the log in the price. Of course, now we don't know P2 plus 1 if we're at time P2. We assume we're at time P2. But if we go back in history, of course, we can measure and see how good these things were satisfied. Yeah. Okay. But this is the actual price. The expected actual price return is this part here. The actual price return is without the expectation. And now this means they're going to continue the process. The rho here is the probability of a crash. R bar T is the return going forward. So we're either going to continue the process or do a correction and recovery. That's the probability, that's the return of continuing as is. This is a correction and recovery. This is the probability of the crash. The correction and recovery consists of the log of the prices between the normal price and the actual price, okay? These are negative when the price is above the normal price, which means you're looking at a crash. Okay, the reverse sign is going to be a rally. That will reverse what happens here. Kappa bar is the relative return to the normal price. This little RTD is, well, I put a D in here. Some people think of it as a discount rate. That's not actually what it is, but it's an estimated return on the horizon, on the investment horizon. So if we're at any time T, if time T is today, all we're looking at is this piece of the equation here. If we're going back in time, we can look at this without the expectation, see the actual price, and see if it does, how much it coordinates with this part here. Both of these are going to be used down the line. That's why I mentioned them here in one part. This looks fine. Actually, it turns out kappa bar, we did a study on this at ETHC. Kappa bar is relatively stable, so is N. The difficult parts are the rows and the returns, okay, as to be expected. The metrics are output to model with indicators with reliability. In other words, we hope to provide you with information. Actually, Rob has a nice slide on that at the end, how reliable these estimates are, because you can see these are the difficult parts. The good news is we don't have to get them exactly. What we have to get them is relatively good. Relatively good means we end up winning more than we're losing. Okay, what about the super exponential condition? Okay, the price acceleration at an unsustainable rate. So we have to solve for the excess return, how fast it's increasing. And as you can see, again, this is an example here. It's increasing so fast it comes up to a point and then crashes down. Hence, the crash probability is supposed to go to 1. That's what we want. How do we get it out of here? So this, if we go back, let me go back one step. If we solve this equation on this part for that condition, we can get this. R bar minus that. This is the excess return beyond what is considered to be a reasonable price. Oftentimes, we end up using, we don't have a better estimate, we end up using the rate of return on the normal price for the RDT. And that sounds perfectly logical, and it works out fairly well at various times. And then you have this component here. This is the excess return, R bar above, okay, discount rate or the short term or the normal price return. And this is what comes out of that previous equation. It's rho kappa log N over P over 1 minus rho. What this means is that R can go to infinity. It's not going to ever go to infinity, but it can get big, and that can cause rho to go to 1. Perfectly logical. Without P, without the actual price having to go to infinity. That's the point of the process. So that means as it accelerates, it increases the probability of a crash. Echo integrates its bubble model with the Kelly criterion. You probably know this, a little background what the Kelly criterion is, but what it does, it maximizes the return by increasing the bet size when the probability are in one's favor. Okay, well, that's nice. Of course, you have to get those reasonably well, and reducing them when they're not. Extending the work of Claude Shannon at Bell Labs, who developed the original concept for information technology and signal processing. And then the MIT, unfortunately, Kelly passed away, didn't have a chance to do too much of that. He was in an accident. And then took the concepts of the Kelly formula to Las Vegas and did pretty well, because what he was able to do is the cards that were played in blackjack. If he was able to count the cards, then he could better estimate a relative probability. And then when you get a relative probability, you can make your bet depending upon how good the probability looks. He did well enough that the casinos wouldn't let him in. And the other thing they started doing is more aggressive reshuffling the deck. Once you reshuffle the deck, you're dead because you can't estimate the probability. But at any rate, Thorpe went on and took some of these concepts to generate Princeton Newport Partners, which did very, very well. Okay. And the whole idea is to look at the excess return, mu minus r over sigma squared, which is the edge that you get over the risk. Warren Buffett is a Kelly better, so said William Zamba, by the way Buffett bet. To apply Kelly, one needs good estimates of the returns, as I mentioned to you, the probabilities, and the jump sizes. When will they occur, and how much will they be? I might take pause here if anybody wants to ask any questions.
I may have a few questions, but probably I will leave them to the end of the presentation. I have a few questions to Kelly criteria and how to apply that, but let's leave them to the end. So I will ask it at the end.
Okay. So application is coming down the pike.
I'm just curious about the publication of this book, Beat the Dealer. That must have happened after the casinos started reshuffling the decks.
Yeah, definitely. Definitely. Yeah, it was after. It was after.
It was quite a bit after. I don't know the exact date. I have the copy in my thing here, but it was quite a bit after. Yeah.
But as I know, the casinos are very happy about the book because as they are shuffling, I mean, there are still the people who are reading the book. They do not. Yeah, they do not know that at the moment the odds are still with the casino because as they are shuffling, I mean, you cannot count the cards. Right. But because people think that they can beat the casino, I mean, they have more money coming into casino.
Yeah.
So they are quite happy with the book.
I think Kahneman calls that the illusion of control.
Yeah, exactly.
Right. Bill Zamba went on to write several books on racehorsing using some of these concepts too. I don't know if you saw those, but he loved his racehorsing, and apparently they worked fairly well for a time. I don't know exactly how they worked. I never was into racehorsing, although it looks like a beautiful sport. So in the last slide, I mentioned that echo works anytime, anywhere. What does that mean? Well, that means that echo is not just for bubbles. It actually is designed to work almost any time. It calculates a bet size, which is a level of leverage or hedge in the next period. And it uses the Kelly criterion to maximize returns. So that means whether you're in a bubble, whether you're in a positive bubble, meaning you might crash, or a negative bubble, meaning you might recover, or you're just sort of chugging along. It attempts to calculate bet size at any point in time. The second thing is it calculates the distance to the normal price. Well, this is a factor of the correction back towards what I have called a normal price. Here you see an example where the actual value, and this is in log terms, is oscillating about this red line here, which is we call the normal price. Some people like to call it the discount price, but I don't use that because that's not what it actually is. It actually is the price upon which the actual price oscillates about. So this gives you a measure of how much, if there is a crash, it'll happen, or if there is a rally, it'll happen. There aren't very many decent rallies here. The correction probability is the probability that you're actually going to return towards the normal price. In other words, it's the correction probability based on a correction size, which is also calculated as part of the whole process. The new model calculates a probability in this form here. We'll talk about this more later, but really what this is, if you divide through by these factors, it basically is the excess return beyond normal price. It looks like this. And the important factor here is this K log Q divided by R minus RD. This is the accelerating price. This is the correction likelihood, and this is the correction size, how much you move back towards the normal price. If you're in an accelerating return, then log of QT, because you're going to crash back, is a negative term. So this looks like 1 divided by 1, this negative and this negative makes it positive, about a term which is positive. So this probability measure here, in that case, is always less than 1. What happens is that the acceleration, R bar minus RD, gets much greater faster than the correction back, in which case, if that happens, the probability, as you see, goes to 1. The last thing I want to mention here in terms of how echo works is the output quality. How good are these estimates? Because that's very important. They're determined in part by a historical process, or actually it's machine learning, but part of AI. Check on the model parameters and the outputs. In other words, use them or don't use them, because the likelihood that they're very good is not very high. So in this case, you get information about how good the estimates are, the exponential acceleration that's indicated, percent of the probability, in other words, is it a good measure or not, correction probability, expected return, and distance to the normal. All these factors are provided as outputs to the process, and they allow you easily to merge with your legacy-rich management system because they provide you with probability and size of crashing or not crashing. And now we'll go into some of the more details of the process. So what do we do? How do we estimate that? I've been barking about it for some time now. And what we do, there are several ways to do this, by the way. This is one of the ways. And the whole idea is to find an estimate of the probability of a crash based upon how big you are away from the normal price, right? That's another way to think about it. Not only if you accelerate, but if you get farther away, if you look at the graph, it looks like, okay, so if I'm farther away, I have a more likely increase in the probability that I will get a crash. So you estimate a probability function, which is based on QT, which is just the ratio of the normal price to the actual price. This is not the log, by the way. This is clear. So point is that QT has to be a number between 0 and 1. And this happens as long as B is greater than -1. If QT is less than 1, A is greater than 0. And if not, then it's less than 0. In other words, you get crashes and rallies out of this and the estimate of the probability based on how big they are. Okay. Now, the thing is, you have to estimate A and B. If B is less than 0, then the crash can occur in finite time. Why? Because the new denominator then, if B is less than 0, becomes less than 1. And if that happens, then 1 minus QT to some power A can equal 1 without becoming very large or going to infinity. Okay. The question is, can we estimate A and B? Well, okay, we can do it. How well does it work? Okay, I think it works reasonably well. There are other ways. We're looking into other ways to estimate the probability. So you minimize the sum. Now, remember what I said. You go back in time and you get the rational RE equation in terms of the actual prices. So how well do these fit in terms of substituting this probability function in here? Okay. Now we go back and see how well this fits and calculate an A and B based upon the minimizing the least square sum of this equation here. To get the K, we use a method of Arduino and Who, which is a method to test if R is a jump. In actuality, we're not estimating crashes here. We're looking at jumps. In other words, things that happen very relatively fast within the time interval that we're measuring echo process. So now we have a way, whatever you think of it, a way to estimate these. If the sum is a good fit, then we take A and B parameters for what will the probability be in the next interval of future time. Kappa bar is estimated based upon the history, how big QT happens to be when we actually have a jump, positive or negative one. And the positive are separated from the negative. We tend to find out that crashes tend to be more abrupt than the rallies. Okay, you get jumps and rallies, but they're not as big, they're not as frequent, they're not as extensive as the crashes are. Now we have a reasonable method to calculate the rho and the kappa. So now we apply the Crowley criterion to maximize the log of wealth. Most of the time, you think of the Crowley criterion, it's really sort of a discrete model, and of course it is. And the simple way to make it a continuous one is to look at maximizing the log of wealth. In other words, essentially, what is the return in wealth from WT to WT plus 1, and maximize that expected return. So what is the lambda? That gives you a combination of the risky asset and the risk-free asset over the period of time. A bar is the expected real return, and we often take R to be 0. If you have a risk-free rate, if there is such a thing, and you're able to use it over a short interval of time, of course, you can slip it in here. But this is what a fundamental equation is to apply a Kelly criterion to continuous time. Maximize the expected log of wealth. So this can be worked out algebraically, but it's not going to come out exact. So you're going to get an approximation for lambda. And it's going to be approximately equal to a messy expression, which I don't put down here, but which you can find in the original paper by, interestingly enough, myself and Professor Sarnett on bubbles, by what the actual expression that we get for this is, excess real return divided by Brownian motion volatility, because you're getting both here, plus the expected jump volatility. Right? So it incorporates basically everything in the science. The bet size, or what we call a hedge, is a levered buy or sell weight. We use machine learning to look at the historical calibration. You saw the model, but you don't actually know what goes into the model. I'll tell you a little bit in the next slide to get the echo price. This is the echo price is the value of the levered asset using the bet size at each stage. In other words, you may say, okay, double the bet, triple the bet, half the bet, or go short. Echo price then is the value that you get from leveraging the actual price over the next interval of time.
This episode continues in the second part. To follow the rest of the discussion and explore the remaining insights, head to Quantpedia YouTube channel, where the next chapter continues. Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.